Probably worth waiting a moment, Christian, isn't it, just to make sure everyone has had an opportunity to join, just for those that have joined.
Participant numbers are going up there, Andrew. We'll just give it just a moment.
Excellent.
All right. Might kick off with a bit of housekeeping. Thanks everybody for joining us today. Appreciate you taking the time. First thing I'd like to say is we are recording this session today for those people who can't be with us, and we will make that available on our investment website post this meeting if anyone needs to review that. Once again, thank you for making the time. Myself, Christian Damstra, CEO of Damstra, will be running the presentation today, assisted by Andrew Ford, our CFO. And if you have any questions throughout the presentation, please use the question and answers box in the Zoom meeting. Coming to today from Denver in Colorado, over here spending a bit of time with the American team due to all the great things happening here. But Kelechi, why don't we get straight into the numbers for the last financial year and give everyone an update. If you can go to the next slide, please. So key takeaways, 29.3 million of revenue. That's an 18% growth versus the first half of 21 and 25% growth on half two financial year 22. So great growth in that second half. $29 million of annual recurring revenue versus 27.8 back at December 21. 108% net client retention, 2% client revenue churn, gross margins down to 70%, and EBITDA at 1.7%. Really important number there, cash flow, they're operating and investing cash outflow of $1.2 million versus 3.4 million on average for the other 3 quarters of the financial year. Cash balance of $10.1 million versus 9.8 million in FY21. Next slide, please, Kelechi. So some of the major highlights of the year. So we did win those several North American clients, opening up broad international rollout opportunities. Those rollouts are going extremely well, and we see a lot of room to grow with both of those clients, as well as other customers that we're speaking to right now. So lots of great things happening in that North American marketplace. I think if we talk about costs for a minute, we did implement a cost optimization project targeting an upgraded number of $8 million on an annualized basis. As of July 22, we are seeing $5.8 million of that achieved on a run rate basis, which is 73% of that target. And we're staying very vigilant on that to make sure we can hit that target and take us to that free cash flow positive in the second half of FY23. Of course, we did mention FY22 second half revenue up 25%. A few things that we've got going on there in the other areas, of course, our partner strategy, we still believe there's significant opportunities there. We are still investing in that area and we're yet to fully exploit that. And we have changed our teams around to make better use of our partners. So we're looking forward to seeing that the future periods there. And of course, integrating permit to work, safe work method statements, and our plant offering. These are core workflow solutions with strong demand across our current client base, and we're working very hard to bring those to the market as soon as possible. We're still accelerating that international growth with those recent North American wins. And of course, we have some great Asian opportunities as well. So staying very vigilant on those 2 marketplaces. We did shut down our UK office. We no longer have a presence in the UK as part of our cost optimization project. And of course, ticks in the short term, performance was a little bit below expectations, but there is significant upside in the permit to work solution and offering that as part of the EPP. So we're still fully supportive of that. Next slide, please, Kelechi. It's been a year of transition for us. We are executing on a turnaround story, narrowing that cash burn in Q4 with a pathway to positive free cash flow in the second half of FY23. We had that negative impact of COVID. We believe that's now behind us. Revenue, as we said, was up 25% in the second half of the last financial year. US business now has those anchor clients really paving the way for us to become cash flow break even. And of course, we have those 2 legacy Vault contractual issues. One's fully resolved and arrangements in place, and the other claim is continuing on. But we are seeing it as a turnaround. Things are going well. That cash flow is under control now. Our costs are in the right place, and we'll continue to leverage our cost base and increase that return in revenue as we move forward. Obviously, the big focus for us is that cash flow break even in that second half. Next slide, please, Kelechi. Now operating in 20 countries, 953 clients, over 800,000 licenses now, 10 offices, giving us greater efficiency and reach. So we did close a couple of offices down, mainly the UK and our Hunter Valley office in Singleton. So we have been doing some cost out opportunities there. We now have circa 200 employees, down from about 220 at December 21. And we're now operating in 15 languages off the back of a cross-sell, which I'll speak to in just a moment. So next slide, please, Kelechi. I think a really important story here, financial year 18 through to financial year 22, we have sustained 29% 4-year CAGR. When you actually look at it from that perspective, it does show positive growth in the business, and we are continuing to grow, albeit not at the rate we'd all like, but it is showing positive growth across the board there, which is great to see. Next slide, please, Kelechi. New go-to-market strategy to drive that FY23 revenue. Of course, we're going to continue to bundle the core product modules to simplify adoption and introduce those value add-on modules. When we talk about bundling, we talk about that core platform and the backbone and of those other modules. So in protection, it's about bundling workforce management with access control, learning, forms, and safety. We have safe places where we're bundling workforce management, learning, forms, and safety. And of course, prepared people where they've got workforce management, learning, and forms. We think there's a lot of opportunity to continue to get those bundles out there, cross-sell with existing customers, but also introduce those new product extensions that are more value add and less mature in the marketplace that we're getting a lot of interest in around our Damstra Insights platform, around reporting, certainly our data science and analytics, ESG, and our workflows around work packs, swims, permits, pre-starts, and those types of things. So still seeing a lot of opportunity to grow with existing customers, increase the size of our smaller customers, but also add in those new product solutions to potential new customers as we move forward. Next slide, please, Kelechi. Core strategy for FY23 still focuses on these 12 areas. Geography, of course, verticals, product, and financial. Geography, North America, Asia, no UK there anymore. And of course, back home, our construction clients are accelerating across the entire business. Verticals, continuing in those new verticals, facilities management off the back of the TIX acquisition, growing those smaller clients that came off previous acquisitions. And of course, let's not forget our partner channel that we're investing heavily in. When it comes to product, we talked a little bit about EPP and growing that out and continue to unlock the value of the new modules, but also those new initiatives around digital cards, the new company portal, reconfiguring and integrating permit to work. And of course, let's focus on those cost optimizations, the operating leverage, and becoming free cash flow positive second half of FY23. Next slide, please, Kelechi. Bit of an update on the product. Certainly, industry research firm Verdantix has recognised Damstra. They have done some work on us and mentioned that Damstra's experience in infrastructure, ports, and mining make it a good fit for firms dealing with heavy machinery and busy work sites. That's certainly in line with our dirty and dangerous approach of what we're looking for. But what was really interesting for us, if you look at the number of employees and the breadth of the portfolio, they really put us at the top of the quadrant for greater than 5 use cases. We're the only company that they've looked at that really has that breadth of experience in more than 1 or 2 modules or use cases. And I think that's really coming out and starting to be recognised in the industry. So for those high-end customers, greater than 200 employees, greater than 5 use cases, we are the solution of choice there. So we're continuing to drive that positioning. Next slide, please, Kelechi. Bit of a focus on monetising the integrated and modular EPP. Of course, we've got our workforce access control, Damstra safety, Damstra forms, Damstra learning, just a few visuals there to give you a bit of an idea of what that's looking like and how integrated it truly is. Next slide, please. And of course, let's not forget the 15 languages we're now operating in. A couple of sample ones there, English, UK, French, Africa, Hindi, Chinese, Spanish. Not only have we got 15 languages, we've got them because we're using them. And we're using them because of a cross-sell that we got through our TIX alliance when we acquired TIX with a great customer, CBRE out there. And they have pushed us to get there. And we have 15 languages in operation today. And not only have we got 15 languages, we also have the backbone to be able to add languages in a matter of days, not a matter of months. So that's been extremely exciting for us across the entire enterprise protection platform. Next slide, please. Product development is, of course, focused on commercialising data and AI. We've got our data science, intelligent workflows. We want to enable those systemic or systematic decision-making, using measurement and analysis to drive decision-making, and really promote real insights rather than perception, and have people make informed decisions and predict the future rather than waiting for a lagging indicator. So a lot of work's gone into that, and we'll continue to leverage that as we move forward. Next slide, please. And of course, I mentioned Damstra Insights earlier. It certainly makes our reporting a lot easier across the entire platform. You can now do reporting from every single module in one location. It's extremely powerful. Users can do it themselves. They can set up their own dashboards, their own reports. They can automate it. And it really does bring us up to the latest technology in analytics and reporting. Next slide, please. I'm going to hand over to Andrew here to talk about the financials a bit more, and then we'll go back to some of these questions that you've been asking. Thank you very much, Andrew.
Thanks, Christian. Looking just to add to a little bit of flavour of a lot of the points you've already raised, so I won't labour the point. Just key financial highlights, starting with revenue growth on a like-for-like basis. 18% growth for the year, and importantly 25% in the second half, which again is an important number because that gives us confidence going into FY23. As Christian mentioned, we achieved solid growth from our existing customer base with client retention at 108% and churn at 2%, so a little bit higher than in past years, but we've now included the customers from our Vault acquisition, so that's it contributes to that slightly higher number, but it's still at quite low levels. Within that revenue, ticks look probably underperformed a little bit below our expectations since we acquired them, but we are seeing cross-sell opportunities now, and we expect their contribution to improve in FY23 as well. As I said, the half-on-half growth of 25% is very pleasing, provides a solid base moving into FY23, and obviously we've got the support of the US contract wins toward the end of Q4, which is helpful as well. They're not fully recognised in the last quarter's numbers. Our GM percentage was down, largely mix related. The ticks business, which we acquired in October, does have lower gross margins, so that was a contributor to the lower margins. We expect the margins to improve going forward. As you know, we're focusing on those cost savings. Some of those are direct costs, some of them are indirect costs, so that will help increase the margin, as will a leverage benefit where our direct costs, some of them are fixed or largely fixed, so they don't go up as revenue goes up. So that gives us an opportunity to improve our margin once more. Christian mentioned about the cost saving program, $8 million up from $5 million. Pleasingly, a lot of that's been realised. So more around 50% of June, but importantly, by the end of July, that's increased to about 73% of those cost savings on an annualised run rate basis. So we're pleased that they've, that's been successful. There's still some work to go. We expect to get there by the end of December, but to have achieved, that extent of cost savings so far, I think, is very pleasing. We can see that coming through, one, in results, but two, importantly, in the cash flow in particular. Half on half, I think, is an important story to call out. As we said, the revenue up 25%. There's a little bit of residual revenue from Newmont there, but there's nothing in the second half. EBITDA was positive in the second half, which was a small negative in the first half. Gross margin a bit lower again, as we said, due to mix, but importantly, our second half costs lower as a percentage of revenue, which we expect to continue. So I might move on to the next slide. We've talked about our cost base a fair bit. Just want to give you a sense of the achievement of that and the timing. As we said, 5.8 million at July, and then steadily increasing, over the next 5 months to December. So we're very confident of achieving the full extent of the cost savings by December. That really underpins our pathway to cash break even in the second half, along with obviously some revenue growth. But the cost savings project is very much in our control, and we're very confident of achieving that. One thing worth pointing out, it does include its net of staff salary increases for FY23. So there's a bit of cost inflation in there, if you like, and that's factored into the 8 million already. So that's just an important note. Might move on to the next slide. R&D. In recent years, you can see we've had a profile of increasing R&D as we integrate products from acquisitions and build out the EPP. I guess from now on, we expect that to stabilise going forward as we benefit from the work done to date. Notwithstanding high developer costs, because as we know, there's pressure on wages out there, but notwithstanding that, we think the costs can stabilise, and we do expect to see a reduction in R&D spend as a proportion of revenue going forward. As we get that leverage benefit, if you like. We don't have to spend as much on R&D. We get to enjoy the benefit of what has been done to date and use that to grow our revenue. So that percentage will start to come down. As you can see, second half versus first half, the trajectory's changed, and that percentage of revenue has declined. Moving on, Kelechi. Cash flow. Important slide and an important message. As we said in our Q3 release back in April, we flagged that our operating investing cash flow would be about negative 1.5 million for the quarter, which is significant improvement on the previous 3 quarters before it. Pleasingly, we were better than that. It came in at 1.2 million outflow. So that was really positive for us to not only achieve that guidance, but outperform it in the fourth quarter. That gives us a lot of confidence going forward. And now we're proposing, as we flagged, I think at our last quarterly result, that we want to focus on free cash flow. So include other cash flow items are obviously important around interest payments and lease payments, and focus on that free cash flow line as highlighted on the chart there. So again, a similar improvement, in performance there in Q4, and that gives us the springboard to improve in FY23, continual improvement in the first half of 23, but then with the goal of getting to cash break even by the end of this calendar year and cash flow positive into the second half. So that trajectory will continue to improve, and as we said, get to cash flow positive in the second half. So we'll focus on that line. Now that we have defined that there, as you can see, it excludes things like any acquisitions or any repayment of borrowings and the like, because that's kind of not really an underlying cash flow, but we'll focus on that going forward. Moving forward, on next slide, yep. And look, just very briefly, just touching upon the normal EBITDA reconciliation we provide. Most of this is consistent with what we've done in the past, and certainly at the half year, the biggest item there is the impairment of goodwill and other assets. We have added one other line item there around restructuring costs. So we have incurred some costs in delivering those cost savings. So about $300,000 of restructuring costs and redundancy costs, for example, in achieving the June cost savings of about 3.8 million. We don't expect there to be a lot more. There might be a little bit more as we fully ramp up that cost saving project, but certainly not significant in the scheme of things. Look, that's probably all I wanted to touch upon. I know we've covered a bit of that already, Christian, and I'll hand back to you to talk about the outlook.
Yeah, thanks, Andrew. We'll go to the outlook and then we'll move over to some questions, but certainly some revenue guidance there for FY23, revenue of 32 to 34 million, EBITDA margin 14 to 18%, free cash flow negative 2.5 to negative 0.5. Key assumptions there, of course, no material change in the market conditions, such as the re-emergence of COVID restrictions. The cost optimisation project being delivered as planned, which, as we said, is very much on target and going extremely well. Client retention %, client churn no worse than FY22, and no deterioration in working capital efficiency. So good, strong outlook there given the current market conditions, and we'll continue to strive to meet and exceed those numbers for the coming 12-month period. I will jump over now to some questions that are coming through, and I'll hand them off to the appropriate people. Anonymous attendee, could you walk us through the assumptions underpinning your FY23 guidance? Do you expect to be able to replicate the 108% net revenue retention as your starting point for growth from existing clients? And what new client assumptions are needed for the bottom and top end of the guidance? So a very good question there. I might get Andrew to touch on that first, and then I'll come back and close out if needed. Sure.
Look, I think the way to think about it is our ARRs, as we said, around 29 million exit run rate out of June. And to get to the guidance level, it's pretty much 3 buckets. It's the bucket of the existing customer base and growing that, so similar numbers to our client retention and churn. We're kind of assuming similar numbers there. That's one bucket. Second bucket is growth within our existing customer base, where we think we can grow. For example, a good example is a Barrick or a Capstone, where we've got a phase 1 already locked in and being implemented, as Christian talked about. but extending into a second phase or additional sites there. So it's really an extension of our of existing customers. And the third element is new growth. So as we talked about, we're looking to expand into Asia and obviously expand into different verticals, with new customers. So I guess it's broadly in those three categories, it's fair to say.
Thanks, Andrew. Second question we got come through also from Anonymous was, what is your July run rate of cash costs for the business?
So look, we don't quote the exact number of our cost base, but I can tell you that it's slightly ahead of our target. So that July number of 5.8 million of cost savings, as we talked about, is slightly ahead of the target, and that's reflected in the cost base. So that was pleasing that July came in a little bit better than we thought, not massively, but it just gives us confidence that those cost savings are being delivered and the cost base is at the level we want it to be to get to our target.
Thanks, Andrew, and sorry to lean on you again, mate, but what incremental revenue from those Q4 client wins that we talk about, is there any of that included in our ARR or not?
Yeah, look, there is a little bit in there. The ARR is based on essentially a June exit run rate. So we did have Barrick, the first phase of Barrick, have their subscription revenue in the June number. We didn't have some of the Capstone revenue in, that started in July. So look, there's an element in there and a little bit that's not, is probably best way to answer that.
Perfect. James Bales, what are TIC's standalone GM? How have organic GMs trended, and what is your expectation for FY23 GM?
So I can probably answer this one as well, Christian. The TIC's business has had a bit of a different model traditionally, and you can talk to it as well, Christian, around some of their hardware sales. They sell a bit more hardware than the traditional Damstra business, which is more of a rental model. So that lends itself to slightly lower margins overall. We don't necessarily talk about or quote the absolute margins, and increasingly the TIC's business is becoming integrated. So it's not something we're going to necessarily focus on as a standalone business. Is going to have obviously its opportunities, but the cross-sell and the integration as part of the wider platform is what's important. So we don't measure it as a go-forward business going forward. Christian, do you want to add to that at all?
Yeah, no, I think you really hit the nail on the head there. TIC's is a different business from that perspective, selling hardware, not renting hardware. They also work in, some of their deals are a lot smaller than the ones that Damstra has usually worked in. So their GMs are lower. Certainly from a standalone organic perspective, the Damstra GMs of the base business are still trending very well. And we do expect those to recover across the board once we do integrate TIC's entirely after October and their earn-out period's over. We'll get into that. So we do see that turning around again. Anonymous attendee, for FY 2023, you're forecasting revenue of 32 million at the base end, yes. Based on 200 staff, this is 160K per employee. Low amount of revenue generated per employee. What is the vision for the organisation size? Look, right now the organisation is circa 200. We are sub 200 today. We didn't put an exact number in there. We are continuing to review the size of the organisation and where that money is spent. Certainly our cost optimisation project did include some cost out that has already taken place, and we'll continue to watch that as we move forward to maintain our target. We would like to see more revenue per employee, and we'll continue to drive that, but I can't give a definitive answer on that here today. Anonymous attendee, any idea of Damstra's percentage share of the market you play in, and what is the future goal? Look, we do, and we think our share of the market is actually relatively low, even in Australia, where we've got great penetration in construction, which is, all the big construction players, we have a play there. But certainly between construction and resources, we think we're still in the sub sort of 20-30% range in the Australian New Zealand marketplace alone. And certainly when you get into the North Americas, Asias and South Americas, we're still talking sub 1%. So we've got a long way to go, and we're continuing to drive that. We're getting a lot of recognition, a lot of notice off the wins we've been doing in North America, and certainly out of those larger organisations who are really seeing the benefits of having a platform rather than a single point solution. So we're continuing to drive that, continue to invest in that, and that's certainly, we want to be seen as the leader in that area, and we'll continue to strive to get there. James Bales, R&D guidance of less than 40% of revenue implies flat to negative total R&D spend year on year. Have you or do you plan to reduce team size? If so, what product initiatives have been deprioritised? Really good question, James. Obviously, as part of our cost savings project, we went through all of our R&D team and all of those types of things. we actually haven't deprioritized our product or our platform. What we've been able to do is get more leverage. As you know, we did a number of acquisitions over the years that had to be fully rolled out, and we're getting to the end of those rollouts. We're getting to the end of those changeovers. We're being able to shut down some of those legacy systems that we've wanted to do for a while now. We're really focusing on getting them shut down faster, and that's certainly giving us those savings. So we're not planning on reducing that team, but we are planning on changing the way that we're managing the product going forward. So we're working on business as usual and not just trying to integrate those products that we acquired over the years. So we're in a really great time for R&D. Anonymous asked, Christian, can I please talk to the pipeline of sales and opportunities that I referred to earlier? Obviously, I can, not in great detail. We've got a great number of opportunities here in the US right now. We're talking to over a dozen different companies. Some are in early, some are in late stages. We've, of course, got some great opportunities in Asia that we've been sort of hanging out for, and we've done some great trials over there that are certainly material in size. And of course, back in Australia, I mean, there's a lot of growth, not just in construction, but also in resources and new opportunities. So we are very pleased with where the pipeline's sitting. We're continuing to invest in our partnership team to make it go even faster. And we do believe we're heading in the right direction there. We've certainly seen a turnaround. We talk about that turnaround of our business. We've seen it happen now at the end of COVID. We're getting our costs under control, and we're seeing the interest increasing day on day now that the EPP is becoming more mature and is being more widely recognised by people like Verdanics and the others in the field. So really, really pleased with the opportunities there. Just confirming that being operational cash flow break even by the end of 22 is on a run rate basis, not the whole period. Andrew?
Yeah, that's right, Christian. It is on a run rate basis. In our guidance, we talk about cash flow for the total year of between, at the lower end, 2.5 million outflow and 0.5 negative or 0.5 outflow for the full year. So that is, our statement is around a run rate at December. So second half being in itself cash flow positive, but not for the whole year.
Correct. And Anonymous also asked, what's the CapEx guide for FY23?
So look, we don't provide specific guidance. That can be, a bit of a factor on mix of sales going forward. It's probably fair to say I think our CapEx will be a little bit higher because we are supporting some construction projects that will require some access equipment that we need to buy. For example, we talked about the Northeast Link program. There's some CapEx in relation to that. But you're probably talking within few $100,000 or $500,000 of kind of last year, but we do expect our R&D capitalisation, if you like, to reduce a little bit as we talked about, given where we're reducing spend there, or certainly not increasing at the same extent of revenue.
Absolutely, thanks, Andrew. James Bales, a follow up to the GM question. Software sales grew year on year. Rental hardware revenue declined year on year. Can you please reconcile to comments around a shift in mix to hardware sales? Look, I think the easiest way to explain that, James, we're still selling both. We're still renting a lot of hardware, and we're going to see a lot of growth in hardware this year as well, off the back of the Eastlink project and all those types of things were happening with CPB. But what we also saw was we had hardware out there during the COVID period for facial recognition and temperature taking. We saw a reduction in that hardware because COVID's come off the boil. And that's really what you saw there in a move in hardware compared to the year-on-year numbers. Anonymous attendee then asked, are the 15 languages across all the different products? If not, is there plans to roll out the other languages across all products? The answer is almost. Certainly we have, it's across the entire enterprise protection platform with the exception of our asset management module. We are rolling it out to the asset management module at the moment. It didn't have as high a need as the other modules because we didn't have that international demand that we had in the other modules. But certainly we are seeing that now. So we are going to roll it out and we are going to sustain that across the entire platform. We don't want to have any part of the platform forgotten. If I just jump back to James's question before about hardware, also, James, let's not forget that new mod hardware came out of the mix as well. That was a very hardware intensive project. So thank you for that. If I just move on to the next question there. Anonymous attendee, the TIX earnout looks like it has been changed. What contingent consideration remain outstanding for the business?
So I can probably answer that one, Christian. Look, there's two elements to the remaining consideration. There's a deferred consideration component, which is not contingent upon any performance. That's $3.5 million to be paid 12 months after the anniversary. The contingent component, so the second component is a contingent component on reaching certain revenue targets. Based on, we're quite a way into that earnout period now, and based on the numbers in our forecast for the next couple of months, we don't think that earnout will be achieved. The revenue number won't get quite to where it needs to be, so we've reversed that out of our financials and disclosed that in our accounts.
Yeah, thanks, Andrew. Appreciate that. That's all the questions. Has anyone got any further questions today for us? We'd be happy to take them and answer them.
Well, it's good. It's a busy day for everyone, Christian, so we can probably let them go.
Absolutely. Once again, thank you very much for your support. Thank you for making the time to come and listen to us today. Look forward to speaking to you again soon. Thank you very much, Andrew, for your assistance.
Thank you. See you all.